I don't think we're going to get, $1 trillion of balance sheet increases in 6 months, or even quicker like we saw during the pandemic. Again, apart from some predictable thing happening. But I think it's basically, it's a trend reversal that's going to happen, and it'll be gradual. And the New York Fed in some ways is already kind of telegraphing that when they release their annual report about their balance sheet holdings, they've been kind of pointing to roughly 2026 or so as when they expect to kind of start going back to increasing their balance sheet roughly in line with GDP growth. Give it as the balance sheet as a percentage of GDP is roughly staying the same, but nominally that'll all be going up.
Hey guys, welcome to Everyday Finance. Old patterns eventually cease to make sense in every market cycle. And for Bitcoin, that time may be now. According to Lyn Alden, the conventional 4-year Bitcoin cycle no longer provides a complete picture. Investors have been going through the same cycle for years. Boom, bust, repeat. However, Lyn Alden claims that as global markets change due to new factors like shifting monetary policy and an AI-driven productivity, this trend is unraveling. His message is clear. Macro momentum, not having cycles, will drive the next Bitcoin rise. According to Lyn Alden, Bitcoin is becoming more and more in line with conventional assets, rising and falling in tandem with stocks during significant market fluctuations. Now that earnings are increasing, inflation is decreasing, and the Fed is getting ready to lower interest rates, liquidity is coming back, and Bitcoin might lead the way. Lyn Alden contends that adhering to the old cycle means disregarding the changes occurring in the modern world, where profit margins are expanding, AI adoption is surging, and economic confidence is returning. The emphasis is now on invention rather than fear. If he is correct, Bitcoin may be about to enter a new period that is characterized by steady growth rather than volatility.
I don't think we're going to have a major recession. Recessions can look different when you're in fiscal dominance. By some metrics, 2022 had recession-like aspects to it. One of the phrasings I try to use or have used sometimes is like an emerging market style recession. And when a developed economy is running in a kind of a fiscal dominant way, some of their recessions can look more like an emerging market recessions, which means they might not be as disinflationary. Unemployment might not get as high, but instead the misery index is where it kind of shows up. And for people that don't know, the misery index is basically unemployment plus inflation. In an emerging market, obviously they're more inflationary in general. And so like in 2022, the misery index reached levels normally associated with recessions. But it was mostly because of the inflation side, not because of the unemployment side. And consumer sentiment tanked, purchasing manager indices and stuff rolled over, across the board, pretty negative things. Even had 2 quarters of negative GDP growth. That was, of course, off of the, kind of the 2021 sugar high. So it's debatably if that counts or not, but you didn't have an NBER defined recession, mainly because the labor market didn't break. And I think that going forward, maybe not that extreme, but you can have a softening labor market. You could have little cracks widen. But then generally speaking, what happens is the fiscal deficits kind of gradually widen and they kind of support that almost preemptively. And so it can show up in, unemployment ticks up a little bit, but instead of the disinflation you'd often get in that environment, maybe inflation stays flat or even goes up a little bit, for a number of reasons. And so people kind of feel that something's off, but it's not the classic developed market, huge labor cycle, huge default cycle that we're kind of known, that we know what to look for. I think my base case is gradual. Now things could happen. There's all sorts of war could happen and any sort of crazy stuff can happen. But so putting aside things that are just nearly unpredictable, my expectations a gradual shift toward Fed balance sheet increases, which I don't think they would call QE, at least at first. And I think the closest analogy we have is the 2019 repo spike, which like people deep in the weeds in macro will know what I'm talking about. But to kind of back up, before we got to the early 2020 like hyper printing, the Fed actually went back to increasing their balance sheet in September 2019. And there was this kind of like in macro Twitter, that was a really big deal. Outside of macro Twitter, people don't even know what happened, because it was kind of this small little financial plumbing fire that was kind of quietly put out. And basically that marked the end of Fed balance sheet reduction, the end of the quantitative tightening that they had been doing for quite a while at that point.
Because Powell wanted to shrink the balance sheet, right? He was essentially trying, but realized he couldn't do it.
Yeah, they were trying to shrink the balance sheet. And back then, they basically, the fiscal deficits were widening even before the pandemic. That was kind of the really early stages of when I was pointing that out. There are some others like Luke Groman that were pointing that out.
Under Trump 1.0.
Yes. But that, again, a lot of that was demographics. His unfunded tax cuts that he did certainly contributed, but a lot of that was demographics and otherwise baked in. So it's, a combination of multiple factors, but regardless, the deficit was widening. The Fed was tightening their balance sheet, and bank cash levels got pretty low, which is a consequence of that kind of combination environment. And quietly, these little kind of liquidity leaks sprang up. So it showed up in the overnight lending market. And so first the Fed stepped in and they started doing repo operations. It's a way of kind of providing temporary liquidity. And people were talking, is a bank failing? But some of us were like, no, it's not that bad. It's basically what's going to happen is there's too many T-bills, there's not enough liquidity. So it looks like the Fed's probably going to have to shift to balance sheet increases. They're going to have to buy some T-bills. And by October, so something like 3 weeks later, they did in fact announce that they're going to now just outright buy T-bills, even though what seemed like a repo problem, that was actually kind of a symptom of the underlying thing. So then they go to start buying T-bills. They didn't want to call it QE because they were not buying duration, and they were not doing it because they felt the economy needed stimulus. They were doing it basically put out a liquidity, fire, a liquidity plumbing leak, different reasoning. And it wasn't explosive, apart from the initial couple weeks. After that, it was kind of pretty gradual balance sheet increases. And I think that they partially learned from that. So they have standing facilities in place ready to respond quicker than they had back then. So we've already seen when they need it, repo is available to tap. And I think that they're going to shift back toward accumulating T-bills again, probably in 2026, but we'll see. And it'll be without much fanfare. There'll be probably a few weeks of across macro Twitter and Bitcoin Twitter, a lot of people talking about it. And then that'll be kind of a new normal. That'll be kind of a new low in the Fed's balance sheet. I don't think we're going to get, $1 trillion of balance sheet increases in 6 months or even quicker like we saw during the pandemic. Again, apart from some unpredictable thing happening. But I think it's basically, it's a trend reversal that's going to happen. And it'll be gradual. And the New York Fed, in some ways, is already kind of telegraphing that when they release their annual report about their balance sheet holdings, they've been kind of pointing to roughly 2026 or so as when they expect to kind of start going back to increasing their balance sheet roughly in line with GDP growth. So you can think of it as the balance sheet as a percentage of GDP is roughly staying the same, but nominally that'll all be going up.
Today's markets move at breakneck speed, as Lyn Alden points out. In just a few seconds, a single tweet can cause billions of dollars to flow in or out, escalating feelings of exhilaration and dread. He warns that although bubbles are usually present in some part of the system, the market as a whole is not necessarily in a bubble. He believes that the current AI bubble is misinterpreted. While some firms with no income may be overhyped, overall profitability and growth are still based on actual economic growth. Both corporate earnings and nominal GDP are continuing to rise. For this reason, Lyn Alden believes that the general fear of bubbles, inflation, protectionism is unwarranted, particularly in relation to Bitcoin. Bitcoin has been mostly range-bound this year, despite stable money supply growth, rising gold prices, and the rise of stablecoin marketplaces. He interprets that as evidence that big investors, or whale investors, have already sold off in anticipation of a 4-year cyclical slump. However, their early selling might actually open the door for a robust recovery if that pattern breaks. According to Lyn Alden, the focus will permanently change from speculative cycles to structural acceptance once Bitcoin reaches its previous all-time highs. The geopolitical environment influencing the world economy, in particular, the changing trade tensions between the United States and China, and how these dynamics are changing demand for essential commodities like gold and rare earth elements, is the second significant issue he discusses.
So I think five's certainly more doable than 4, but I think that There's some things I'm more sure on than others. One is I don't think we're going to see a new low in mortgage rates. I think we've seen like the generational low, my base case. I certainly think we can go off our highs. Judging by what we saw this week, and actually the last time the Fed cut rates, which was something like 9 months ago, longer rates don't necessarily follow when they cut rates. So sometimes the long end of the curve, treasuries, mortgages, things like that, sometimes they go sideways to up, even if the Fed is cutting. It could be because the market is, losing confidence that they're going to control inflation. Therefore, they price it into the longer end of the curve, whether it's mortgages or treasuries. Other times, it could just be a trading decision, kind of liquidity analysis and things like that. My base case is we'll be in this range. To get lower on that range, it could be that the Fed or others do actions to push it down. Or it could be, going back to some of those other things, that the labor market breaks more than it has been. If maybe we have another tariff escalation or, kind of basically a major tax increase, if some of these things hit and do slow things down more than we've seen for a little while, you could get a pull down and longer in rates. But it wouldn't necessarily be the type of environment people are looking for, because it could be associated with job losses and things like that. So I think the challenge is, regardless of where they end up, I don't think we're seeing a lower low. And that also means that there's no big refinancing cycle. So in prior major Fed cutting cycles and new lower lows in mortgage rates, it kind of ends up being a nearly free lunch for the consumption economy, because everybody who has a mortgage can go ahead and refinance it pretty much, whether it's recent, whether it's older. There's this whole refinancing wave. And for them, it's mostly a free lunch. They refinance everything, and they just lower their bill, and they're happy and they can spend more. And now, if you don't get a lower low, if you only get, we're off your highs in mortgages, but you don't get a lower low, then the percentage of people that can actually refinance is only the past few years. And that was very low volumes. So there's not a ton of people that have these higher rate mortgages. So you get a very weak refinancing cycle. So that's less, even in non-housing, just less money that's just kind of more freely available to families to go out and buy stuff. So you can get more of a malaise, and that kind of two-speed economy we were talking about earlier can persist longer than people think, because there's no big refinancing cycle coming to the rescue. It's mostly just what we see now, and we can see what Congress decides to do, what the president decides to do, but a lot of this is already locked in. This administration in particular, but also any administration, there's usually multiple camps within the administration. And so there's certain groups that see a certain thing playing out, and there's another groups within the same umbrella of the same administration kind of seeing it a different way on a given issue, whether it's trade, whether it's what to do about the debt, things like that. Even the playbook we've seen, if you look at Stephen Mirren's paper from, I think, November 2024, the one on resetting global trade, it's kind of, one of Trump's, economist trade czars, kind of laid out the, pretty sophisticated approach to what they want to do. And that generally called for a temporarily stronger dollar during tariffs and during negotiations, at which point they'd come to the table and do something like a Mar-a-Lago Accord to weaken the dollar. And so far, the game plan hasn't played out like they expected. You've had a weaker dollar during the tariffs and the negotiations.
And why do you think that is, just by the way?
Partially I would say because the market kind of somewhat called the bluff, which is the U.S. doesn't have we don't have the strongest hand. We have a strong hand. We don't have all the cards.
Yeah, not all the leverage anymore.
We've got cards. China's got cards. All of BRICS has cards. Probably the block that's weakened a lot of the cards is Europe. So they don't have a ton of cards,
and they did that to themselves, oddly.
Yeah, pretty much. Yeah. So other than Europe, a lot of these bigger entities do have cards, and I think the market correctly identified that pretty quickly. The Fed, they do contribute to wealth concentration, but at the same time, when we talk about bailing out banks, the Fed has partial, they can do some things on their own unilaterally. They can kind of do things that are inflating asset prices. The biggest bailouts are fiscally driven, or a combination of fiscal and the Fed. So, for example, after 2008, the whole TARP thing, that was a fiscal action. Even the 2023 regional bank bailouts, that was kind of Yellen and the Fed working together, basic Treasury and the Fed working together. And so I think the concentration, it's always kind of easy to blame one thing. If it's only, it's just the Fed or just this president or just this. It's kind of this accumulated multi-decade set of decisions. And I would say that probably the equally as big as the Fed would be the combination of fiscal decisions along the way. Who gets tax cuts, who gets tax increases, where stimulus is spent, all these things add up. Even, for example, the PPP loan program, I've kind of pointed out a couple of times, because when we think of COVID era stimulus, we always think of the stimulus checks. That's kind of the big one, or child care tax credits. But the PPP loans were actually some of the more kind of concentrated toward the top when they did analysis on it afterward. A lot of those, they give loans to businesses. Many, of course, small business owners are fairly wealthy themselves. Many of them were not in a position to really be planning on laying anyone off to begin with. And then those loans turn into grants, and which basically means that it just went to the owners of the business. And that could be that could be $250,000, that could be $500,000, that could be $1 million, it could be more. And they've done I don't have the numbers in my head right now, but they've done analysis on this. I've cited it in Broken Money and elsewhere, the percentage that went to very wealthy people. And so it's kind of like whenever things kind of break apart, it's always like, oops, we accidentally shifted more than we intended to the top 10%. And then it happens again. You're like, oops, we did it again. Yeah. And we've had like 4 or 5 of these kind of cycles now.
Lyn Alden takes a step back to consider the world stage in the second half of his essay. He contends that a new trade pact between the United States and China is not only feasible, but also unavoidable. Additionally, it will cause world markets to tremble when it occurs. He believes that the agreement will do more than just lower tariffs. It will reorganize supply lines, restore faith in global expansion, and reroute funds to riskier assets like Bitcoin and stocks. That's what the stats already indicate. Both economies cannot afford to continue the 27% decline in Chinese exports to the United States year over year. According to Lyn Alden, a truce is not only likely, but also required. His analysis, however, is more thorough. He cautions that China's greatest bargaining chip in trade negotiations is now rare earth minerals, which are essential to electronics, electric vehicles, and defense systems. Since the United States cannot replenish those resources quickly, Beijing will have a big say in the next round of discussions. According to Lyn Alden, this is about the structure of world power rather than just economics. As the U.S. shifts towards stablecoins and tokenized finance, China is increasingly focusing its monetary policy on gold. These two systems, gold and digital dollars, will coexist if a trade agreement is reached. With Bitcoin acting as a link between them, we're entering a new period where AI innovation, macro policy, and digital finance come together, which might spark one of the biggest bull markets in years if Lyn Alden's prediction comes to pass. Not only for stocks, but for all digital assets in general. He contends that Bitcoin is developing into a cross-border settlement mechanism, liquidity proxy, and a macro hedge in addition to being a speculative asset. Lyn Alden's message is clear as we approach 2026. Pay attention to the macro tide rather than waiting for the next halving cycle. This time, the market is driving Bitcoin, not the other way around.